Good morning, Tim Nyland here for the Zacks Professional Services Internal Strategy Call. Today is August 26th of 2020, and we're going to pick it up where we more or less left it off last week with this discussion of what's going on with tech stocks, right? So obviously, tech stocks can continue to push not only the Nasdaq to record highs, but also the S&P 500. And this article came out of the Wall Street Journal on Friday of last week, and it pointed to the fact that we literally had 5 of the 6 tilts, according to this article, in excess of 2% outperformance of the S&P 500. And if you look at what's going on in today's session, and again, I'm just bumping over to Advisor Tools now. I've got all my equity watch lists set up, and I'm just scrolling down to my earnings certain portfolio tilts. And I can see actually earlier Adobe was actually up 10%. It just hit 10%. Facebook's up 5%. Amazon up 2.2%. Microsoft 1.7%. Alphabet 1.6%. Apple 1.18%. This group of stocks just continues to perform. And again, we are in interest rate territory and total equity discount rate territory that we've just never seen before. So the value of these companies relative to where interest rates are today, they're just exploding. And so this story was relevant on Thursday of last week. I cut it out on Friday. And here we are on Wednesday of the following week with probably even more outperformance than we had Thursday of last week. So something to keep your eye on, and obviously something we'll be paying quite a bit of attention to going forward. I don't expect this trend to slow down anytime soon, but obviously we'll be keeping an eye on the strength of the dollar, interest rates, and any of those things that could potentially derail this rally. On a related note, over the weekend, I believe I pulled this article. There was another discussion of the market cap of the top 10 names in the S&P 500. And I really started paying attention to the top names in terms of leadership when Apple and Exxon were struggling for first place. I guess you could call it a competition for first place in the S&P 500 right after the Great Recession. And it was then that this type of analysis caught my eye. And again, I don't necessarily manage the earnings certain portfolios themselves to any sort of market cap targets, but I do pay attention to it, especially from the tilt perspective and what's actually driving performance in these markets. And the interesting takeaway with this particular picture is the fact that if you couple the earnings certain portfolio tilts, that obviously encompasses the top 5. Obviously, Adobe's not up here yet, but this is the top 5. And if you look at the remainder of the top 10 in this article, we've got Visa, Johnson & Johnson, Walmart, and Procter & Gamble, all part of the core earnings certain portfolio, the 75 stock portfolio. And then Walmart and Procter & Gamble are actually part of the Admiral portfolio, the smaller 30 stock portfolio. And so again, not that the earnings certain portfolio has managed this. We're not cherry picking just these top names. It's simply a byproduct of the discipline and has been for 25 plus years. So strictly a byproduct of the discipline, and I love to talk about that. Obviously, Berkshire Hathaway up here, a name that we don't own, a huge weight in financials and insurance, obviously generates a ton of cash flow for Warren Buffett, but just doesn't fit our model, not in the earnings certain portfolio. The core holdings outside of that, obviously, in Buffett's portfolio are of earnings certain caliber, though. So Warren does share a lot of the same strategy and discipline that we do. So the bank bets bite the hedge funds, and this was a really interesting article. This is literally the second half of the article that I pulled out of the journal. And it's funny when we talk about banks, obviously everybody knows how I feel about banks. They definitely don't belong in core. They're a great instrument to tilt with, but the interest rate environment's got to be right. And it talks about how all of these hedge funds named in here have literally taken a bath because of their bets on these bank holdings. And so that's where I wanted to spend a little bit of time doing some analysis on some of these banks, specifically just taking a look at banks overall. I think you'll be shocked when you see what I'm about to show you in terms of valuation. This article, I highlighted here right in the middle. It says bank stocks will be uninvestable for at least the intermediate future. And I think that this is pretty timely because I probably get 2 to 3, I'd say probably a little bit more than that, maybe 4 to 5 calls or emails a week from advisors saying, hey, is it time yet? Is it time yet? And I'm urging patience here with the banks, and I think that this article, reinforces that. You're going to see in a minute that banks are inexpensive. I guess the real question is, how much more inexpensive can they get? We have seen a little bit of a rotation, but when we look at one metric in particular, we really haven't, and that's what I want to share with everybody here in just a minute. But anyway, pay attention to interest rates, pay attention to yield curve, pay attention to the spreads at each tranche in the yield curve. And what I'm talking about when I say tranches is simply, your 1s to your 3s to 5s, 10s, 20s. Look at the spreads, and you want to see divergence in spreads, and you want to see an upward sloping yield curve before, or at least the start of it, or at least inflation drivers that would push the yield curve to behave that way. That's what we're looking for. So what I want to do is to explore this banking valuation a little bit more. Is let's jump into the research system, and this is again our institutional platform for portfolio managers, just to do a little bit more of the heavy lifting in terms of being able to slice and dice the scenario. And the first thing I want to point out is, when you're looking at recoveries for these regional, these aren't actually regional banks, these are actually your large banks. 2007 we peaked. 2018 it took to recover. We came back down a little bit in terms of valuation, and then we had this rise up. And obviously, this PE multiple expansion here was driven by the fact that we were actually having a little bit of inflation, and we were actually experiencing, the 10-year getting back to more normalized rates. And then obviously COVID hit. And you can see where we're at now. We've got an earnings trough. We've got some recovery. And what I want to show everyone is that if you look at the S&P 5, I'm actually going to pull up the SP 5 financial sector. There's probably a better way to do this. And you can see that financials actually recovered about a year earlier on the S&P. And again, the financial sector of the S&P includes a lot of insurance companies and a lot of companies that weren't necessarily taken to the woodshed as hard as the banks. So it makes sense that when we strip out, the large regional type mega banks out of the S&P 500 financials, like we do with this particular composite, it actually took about a year longer to recover. And so what I want to show everyone that's using the research system, how you can find these composites. You can go into our Zacks composites by category, and I just literally grab the major banks, but you can grab the major regional banks, any of these, and do this type of analysis. So the idea here is that a lot of people like to look at the PE ratios. And so we'll take a look at that very, very quickly. It's definitely not my preferred method of analyzing banks in particular. And the reason for that is here they really just don't look as cheap as they really are. And if you look at this bank composite relative to the S&P 500, you'll see that on a relative valuation, we've been here before, right? So this is the absolute. Okay, so we've got the S&P 500 up here, and we've got our bank composite in blue. If we make it relative, you can see that the median is 0.72, and we're currently trading at 0.57. So, you know, it's not that we're trading at that much of a discount on a PEF12M basis. So what I want to do is bring up the financial composite of the S&P 500. You can see that same exact phenomenon, right? We're trading at a 0.63. The median is 0.77. So yeah, it's cheap, but it's not really giving us the full picture. The more preferred valuation metric that I like to use is tangible book, not price to book, but in the case of banks, let's strip out the intangible assets, so the goodwill that's on the books of these banks. Let's go ahead and remove that and kind of put everyone on a level playing field and not reward companies for having inflated book value of intangible assets on their balance sheet. And this will give you a little bit of a different story. If you look at this on a relative basis, you can see how cheap we really are. We normally trade at roughly a 63% discount. We're literally trading at like an 85% discount at all-time low levels of price to tangible book. And if we look at just the banks, it gets even cheaper. And so this is really the point I want to drive home today, is that price to tangible book gives you a much better picture. And I'm not saying don't look at PEs. Obviously you can, and you should, but the price to tangible book gives you the real story, right? The idea is you'll always hear in the press, you know, so-and-so banks are, you know, trading below their liquidation value. They're trading below book value or something like that. And I like to take it one step further, and I like to say, okay, well, let's see what they look like when we strip out, you know, the intangible, the goodwill off the balance sheet. And let's see if we can find companies that are trading, you know, lower than that value, which would obviously be a value of 1. So price to tangible book, again, median, normally trading at about a 66% discount. We're trading at an 89% discount. It's crazy. And this is, again, relative to the S&P 500, okay? So let's go ahead and break some of these up. I'm just going to split this composite into its members, and you can see that relative to the S&P 500, I could go ahead and switch this over to the actual bank index. I'm going to go ahead and keep it the S&P 500 because the importance of keeping it at the S&P 500 is the fact that from a price to tangible book value perspective, the S&P 500 has literally pulled away. And so we want to capture that discount, the fact that these banks have been pretty much left for dead in that analysis. If we use the bank index as our relative proxy, then we're going to lose this expansion that the overall market has had. So that's why this is such a valuable comparison. And so I'm going to switch this back to relative by clicking this R button. And you can see that we're trading at literally a 90% discount on a price to tangible basis relative to the market. You know, obviously 77% discount is more the average. Keep in mind that banks just don't get the valuation that other companies get. But I mean, you can just go through this list, right? Bank of New York Mellon, same thing. You're not going to really see anything different here. You know, JP Morgan, right? I mean, some of the shockers. I mean, price to tangible. I mean, the idea here is that at what point are these a buy? I know I don't speak highly of banks, but again, there is a time and a place. It's not now, but certainly, you know, it's coming. Here's Key Corp, right? We've been here before. We know what this looks like. And we can just literally go on and on and on. There isn't really one bank in here, I don't think, unless one of these is going to surprise me. and that is literally immune to this phenomenon. So this is going to give you, a much better idea of how these companies are trading relative to their book value. And this is, again, the preferred valuation metric to look at. So we'll just look at Wells Fargo here for just 1 minute, and then we'll wrap it up by looking at some absolutes. And for some reason, my system just slowed down, so I apologize. As we are doing this live and unscripted, these things do happen. So let's go ahead and take a look at just some of these in absolute terms, right? So some of the companies that I want to bring to everyone's attention that are actually trading below their tangible liquidation value would be a company like Citigroup that's trading at 0.73. Keep in mind, a price to tangible book of 1 would be trading at what you would call its tangible liquidation value. Citigroup is actually trading at less than its liquidation value. I think another one would be Comerica. Yeah, 0.76. And Fifth Third, 0.96. I know Wells Fargo is another one, but I think there's another one up here. I think KeyCorp is probably another one. 0.95 for KeyCorp. And then obviously we all know what's going on at Wells Fargo, perhaps the largest discount and perhaps one of the larger opportunities. Keep in mind, Buffett liquidated his share and loaded up on Bank of America. And you can see Bank of America is actually trading at a 32% premium to liquidation value on tangible book. So anyway, pay attention to price to tangible book in conjunction with the PE multiples and everything else that you do to analyze banks. That is the key takeaway for today. And that's all I had for today, and we'll follow up next week. Thank you, everyone.